Welcome, guys. So in this video, I'm going to take my time and break down the trade I took executing off the 30-second chart on pound. I'm gonna show you all the higher time frame levels that were salient to my execution. See, just because I can execute on 30-second chart, sometimes even 5-second chart, I'm not just solely focusing on those time frames unless I'll lose a lot of times. It still has to be contingent upon a high time frame level or high time frame levels. So it's important to have that in mind. Now, that being said, let's go ahead and dive into why exactly I took the trade at a certain time of the day. Really get into nuts and bolts of why it makes sense. So first, if you notice, this is a weekly chart we're looking at here. Again, we start from the higher time frame. Notice this fair value gap here from this candle's high to this candle's low. Draw that all out until today's weekly candle. Notice we've ran below with a body close that fair value gap, right? So this candle has ran below it. That is very significant. We have to understand and note that since that happened, this sort of tips his hand to give us somewhat of a direction or expectation going forward. So again, this candle has overlapped this weekly fair value gap. And then we go into this week. My expectation is that these levels will be sensitive going forward. On the daily chart, nothing really much on the daily chart to talk about. I don't think so. And then let's go on the 4-hour chart. Really, I think that's where more. So on the 4-hour chart, notice how we ran below. See this one right here? It runs below the previous day's lows, right? So it runs below the previous day's lows. Wonderful. Now let's keep on going. And notice this is by the way, just FYI, you can see this little exposed area on the 4-hour chart. Ideally, we're probably gonna run in there. Notice how we've left equal highs here as well. So just for future prognostication and future, bias, I think we're gonna at least drive into this 4-hour fair value gap. But that's beyond the scope of this conversation. So let me focus on really the trade that I made today. So again, we ran below previous day's low. Okay. And I would like to just go straight into the 15-minute chart here. So again, this run right here. All we did was drive lower during London and New York session. Then we have this aggressive push higher, I believe by news. One push higher. But notice when we make this push, a couple of things happen here. One, we leave. Well, let's start from the bottom. So first of all, notice this little fair value gap here. With this big push, we overlap it. So sort of creating something like we saw on the weekly chart, right? We run beyond that fair value gap. We get up here, and what do? This is the second thing we note. We left equal highs. Typically, the market does not like to. Whenever you see equal highs like that, like to me, that's engineered liquidity, which essentially means that the markets are more than likely enticing people that are retail minded or trade double bottoms. They're enticing them to actually expect these double tops in this case. They want people to think this double top is going to stay in place. Now, you can also say the same with these double bottom right here, but you have to use logic. This is where bias, understanding, and logic comes into play. Remember, we've ran out previous day's liquidity, so we've already done some work here. However, when we ran up here, we left a major liquidity pool in place, which was the intraday's high. So here, this area will have more liquidity resting above it. And on top of that, you also have to pay attention to what was going on in the dollar. And we're going to get to that in just a second. So those are the components we have today. Run below previous day's low, push aggressive higher, leaving a void here. Fair value gap, buy side imbalance, sell side inefficiency. So only buying occurred in this candle, and also leaving equal highs. So what does the market do? It retraces and sees weekly. So this right here is an inversion fair value gap on the weekly chart, which is the levels I pointed out earlier. So it trades back into that weekly level. Wonderful. And more specifically, even trade back into this now 15-minute inversion fair value gap. Now we have all of that in play. And it's also London close. So we have created what you call optimal trade entry. So there's a lot of things that's clicking here. Follow along. It might get a little confusing if you don't understand smart money concepts. But as you keep on learning and watching these videos, hopefully I'll give you more clarity. So you have London close right here. Notice how we ran higher, then retraced into London close. That's significant. The way we move into a session, or especially if we're in the heart of the session, we have a retracement. Ideally, it's probably going to keep moving higher. So a lot of things here. I'll try to repeat it again. Overlap of this fair value gap here. Aggressive push higher. Failure to take out a high. Retrace back in, hitting a weekly level and hitting a 15-minute inversion fair value gap. We don't just enter on a buy, at least I wouldn't. We then watch to see that lower time frame interaction. Before I get into that, let's see what's happening on the dollar at the same time. So if you look at the dollar, this is a 15-minute chart. Dollar will kind of give you more clarity on why we were expecting higher prices. So these PD arrays, like fair value gaps, you want to think of them like magnets, right? So when dollar had this run up higher and then aggressive push lower and start retracing, what it failed to do was touch a higher time frame level. It was close to it, right? Traded higher. Then at this time of the day, right, it failed to touch here, which is a fair value gap, daily fair value gap. So I know that we've ran above these highs aggressively, and we dropped aggressively here, and all we do is trade into a clear 15-minute breaker right here. See that breaker? So this is a series of down close candles before a move that takes out a liquidity pool. That's what a breaker is. At least a bearish breaker. Series of down close candles that then run up higher to take out a liquidity pool. Once market breaks back below that, that's considered a breaker. So we have this breaker here. So many reasons why. So we have this break. So trading back into this breaker without touching this daily fair value gap. So that's why I knew, literally by looking at dollar, not even by looking at pound. I was looking at dollar. So okay, cool. Dollar is going to draw towards this daily fair value gap. That has to be my focus. So that is kind of what gave me the mindset to go long on pound. Just because as we traced lower here, especially we hit a weekly level again, and I'm seeing what's going on in the dollar, that is all putting the logic together of how the market is likely to move. And we also have equal highs here. So I just want to point out the dollar here on the 15-minute chart so you can see how it makes sense for it to gravitate lower since, again, these PD rays act as magnets. Now, to the 5-minute chart. And I don't think I even did anything on the 5-minute. Really, it's more 30 seconds. I'm just going through every time frame. Actually, I did. So on the 5-minute chart, another thing that I did like that even made me really trust it as well was we had this low in price that also made a higher high here. So when market ran below that liquidity pool, because some people chase this and put a stop loss here, right? We run, boom, below it. I was happy to see that. And again, notice the pattern here. It's optimal trade entry. Starting at 10 a.m., we ran higher, and we traded back into this move higher. So this is an optimal trade entry pattern as well. So in the heart of London close, which is between 10 to 11, I like to extend mine from 10 to 12 sometimes, we are having a retracement back into a weekly fair value gap, and consider this a 5-minute order block. So now I'm digging deep. It makes sense. We've ran out of liquidity. We left equal highs here. We're retracing back. Let's see what happens. That's my mindset, right? And on 1 minute. So on a 1 minute chart, it's not really the best. I mean, entries did pop up right here. Like if I was on a 1 minute chart alone without looking at 30-second chart, I probably wouldn't have entered the market until right here. Boom. That was my entry. Stop loss below here. Why? Because we have this last significant move lower. We didn't break that structure until this push here. And then we'll drop sort of close to the high end of this now 1 minute inversion fair value gap was shaded in green. So we failed to, touch that. Another thing I'd like to point out very quickly here is that this orange line here is a 15-minute inversion fair value gap. Let's go back to it real quick on the 15-minute chart. You gotta bear with me. This is very mechanical here. So a lot of moving parts. This is a 15-minute inversion fair value gap. Once we trade it above it, I cannot expect this level to act as support, which we did get here, a little push higher. Now you can see how price just kind of bounced around it again and push higher. But I did want to point out that was a 15-minute fair value gap. And you might be wondering what this yellow line is, or yellow shaded area is. It's also 1 hour fair value gap. And notice how we traded above it, came back in, and it gave us a push higher to even another liquidity pool. So back to now, we're going to go down to 30 seconds to focus on what happened here on a swing point. All right. So now 30-second chart. What do we have? Well, first of all, we had this last run lower, boom, into that 15-minute inversion fair value gap. Then we trade higher, breaking the structure. Wonderful. Now we drop lower again. Right? I'm still not rushing the trade. I don't see nothing that I like. I sort of like to see, for me to enter the trade, I kind of want to see a staircasing sort of pattern where the market, is creating higher lows. I want to see that first. At least one higher low or two. That'll make me comfortable to trade. So that's why as we broke structure here, right? We broke structure. There's not really a staircasing sort of movement, so I wouldn't enter the trade right away. But however, here you can notice, right? When we dropped again, then move higher, create that staircasing moment. And again, this is a weekly. This orange line is a weekly inversion fair value gap. So we trade higher, create this little staircasing pattern. We're trading above a 1 minute inversion fair value gap. We show respect of that. We push higher again. Wonderful. Then we drop back into where I would now consider this a breaker on the 30-second chart, because we had this run up higher, right? That then dropped and then dropped price one more time. So we ran out this liquidity pool right here. So as we're trading higher and higher again, I'm just considering this as a 30-second breaker right here. So We have the 1 minute inversion fair value gap. You can even make this a 30-second inversion fair value gap if we wanted to, right? We can extend this right here. If we want to make this a 30-second inversion fair value gap, but look at how clean price is even acting on a 30-second chart, like almost to the T. So boom, boom. Look at those candles. Nice staircasing pattern. We dropped again into this 30-second breaker, right close to the weekly fair value gap. That's where I enter the trade, and you can see trade executions. Right there, boom. Where my stop loss be really should be below here, but for spread reasons, I'll probably put a little bit lower. But you can see the entry right there, boom, solid. And today, where am I expecting those equal highs here to get ran out? And price slowly but surely just makes its way higher. And look at how we keep going higher, staircasing matter. And then boom, this is the 15-minute version fair value gap I was telling you to be aware of. Look how we touched that and then we expand higher. And I got out here because dollar already ran out its highs and dollar already ran into that daily high time frame level. So oftentimes when you are expecting liquidity pool to get ran out, what can happen is if your intermarket analysis or pair, which in my case was the dollar and euro, are suggesting that they're running ahead of the pair you're trading, sometimes that can cause a full out reversal. So I got out once we touched the bodies of this candle. I didn't have to wait for the highs to be traded to, just because dollar and euro were ahead of it. And you can see me getting out most of my position here, here, here. And I had a stop loss in place. The market traded just right to it, got me out just for it to eventually make its way higher to, yeah, so around that, it ran out those equal highs right here. And then if I don't trade London session. Sorry. I don't trade beyond London close. But if I was, another entry would have been, as we touch into this 1 hour now inversion fair value gap, you see that we went higher, higher, see that staircasing pattern, higher again. As we retrace in here, I would have entered this trade right here and stop loss below here. Believe it or not, I would have done that if this was like an indices or something. But in terms of currencies, I wouldn't trade it. But I've entered right here, stop loss below here, or stop loss below this consolidation here, and I would expect the price to, of course, run out these highs and then run out the other liquidity pool we had up here. So that's kind of how I would have entered the trade right here. Why? Well, look at this. We hit a 1 hour time frame, and we had to run out those liquidity pools. Right here. So we hit a 1 hour time frame, and we have the staircasing pattern going higher. We run above a fair value gap. As we trace in here, this would have been an entry. First target would have been these highs. It's also another liquidity pool that market hit there. So that's pretty much it. I don't think I have. Yeah, that's pretty much it. That's what happened, and I guess I can show you the results, right? So you can see I came into the day with 100 what's today's date? Yeah, the 29th. So I came in there with 106,000. Those actually was in S&P sales, which if you look at indices today, that thing went higher. But I felt that dollar was gonna drop lower, and on top of that, indices were not trying to go lower at all. So I got out after being traded for a little bit, which was a right decision. And then got in pound, and so we started 105,000. Now we're 108,000. So almost maybe 2.7% day, close to 3% day. So that's not bad. But wonderful, wonderful trade, man. I think if there's any other way, any other thing you'd like me to talk about, or if you found that very insightful, please feel free to share with a friend. I really appreciate that. Again, it's all free game, so it would really be helpful if you could subscribe, like this video so I keep dropping more. But thank you for watching, and I hope you have a wonderful evening. Colossal Trader is out. Gotta go eat me some food. I'm hungry.